Hello everyone, welcome to the SBI Securities Weekly Market Podcast with me Sudeep Shah. Hope you are having a fantastic weekend. Today we would be discussing about what to expect in Nifty and Bank Nifty from here on, along with the key levels for both the indices. We will also be discussing on key sectors and stocks that could make a move from here on in the coming week. Now, if we see the price action in the major indices during the week, led by a rebound in IT stocks, we saw Nifty continuing with its buying momentum and witness outperformance in comparison to Bank Nifty. So, while for the week Nifty ended with 1% gain, we saw Bank Nifty losing 1% for the entire week. The stock specific theme seems to have worked really well as real action was seen in the broader markets, wherein Nifty mid cap has surged by 2%, Nifty small cap has surged by 2.5%, and it has marked a fresh all-time high during the week. So this displays a massive outperformance as compared to the frontline indices, where Nifty is still 2.5% away from its all-time high, and both this small cap and mid cap indices have marked a fresh lifetime high. Friends, the main reason for the rally in the last week was the steep decline in US dollar index and US 10-year bond yields below 104.3 and 4.4% respectively. Now, because of these reasons, even the S&P 500 saw strong upside momentum in the last few sessions, and we feel post some consolidation, this index could head towards 4600, 4620 levels on the upside. Also adding to this, Brent crude oil prices trading below $78, $79 a barrel is also a big positive for the Indian currency as well as the domestic markets overall. Now coming to Nifty levels, despite weakness in Bank Nifty, Nifty is showing signs of bullishness led by a good move in IT, pharma, auto and capital goods. So overall, talking about levels, the zone of 19,850, 19,900 zone will act as an immediate resistance for the index, and this resistance zone is defined by a swing high which was formed in the month of October. So October we saw Nifty reversing from 19,850 kind of levels, and this also coincides, this resistance zone also coincides with the gap areas which was formed in September month, specifically on September 21st, where the markets had opened gap down, and this particular zone of 19,850, 19,900 gap area is yet unfilled, and hence we feel that this zone will act as a critical resistance, and for indices to rally up to 20,100, 20,300 zone, this area of 19,900 needs to cross and indices need to close above this level. So on the upside, 19,900 will be the all important level. Now coming to support zones, 19,550, 19,600 level will act as an important support for the index, as it is the downward sloping trendline breakout zone which is formed by joining the swing highs of 20,222 made in September 2023 and the next lower high of 19,849 which was made in October 2023. Now we have seen the breakout above 19,550, indices moving up to 19,850, 19,875 on the weekly expiry day, and thereafter there was a sell-off. So and along with this weakness in the banking sector now, so even if we see some kind of a weakness in Nifty which is sponsored by Bank Nifty, this zone of 19,550, 19,600 will act as an important area. And the second significance of this 19,550 level is that it is also the 50% retracement of the entire fall from 20,222 to 18,837. So in case we see any move, specifically profit booking move accelerating below 19,550, then the next levels to watch out for on the downside would be 19,430, 19,400 levels, where the 20-day exponential moving average is placed. Now coming to the open interest data for the weekly series, significant put writing is visible in 19,700 and 19,600 strikes, while on the calls front 19,800 and 19,900 strikes have seen considerable open interest additions. So overall range for the next week could be 19,550 on the downside and 19,900 on the upside. Coming to Bank Nifty, now what has happened here is that the RBI's new guideline where the risk weight on unsecured consumer loans, whether it is personal, credit card, loan against property and few others, now the risk weights on these have been enhanced, and this is marginally negative for the Bank Nifty banking stocks and NBFCs going ahead. So the higher risk weight means that the banks and NBFCs will have to maintain adequate additional capital buffer to align with the guidelines, and this is negative for this entire space. So post underperforming significantly in the last 2-3 days, in comparison to the broader markets, Bank Nifty has closed at a 10-day low. Now, Bank Nifty has already slipped below 43,750 zone where the 20-day exponential moving average is placed. And now the next immediate important support for banking index is likely to be in the zone of 43,100, 43,200 where the 200 DMA is placed. And resistance on the upside would be around 44,150, 44,200 levels. And only above 44,200, a bigger short covering move is likely to be witnessed up to 44,800, 45,000 zone. But on the other hand, if 43,100 is breached, index could revisit levels of 42,500, 42,700 on the downside. For the weekly series, significant open interest build-up is witnessed in 44,000, 43,800 puts, while 44,000 and 44,500 calls have built up strong open interest, implying a near-term broader range of 43,100 and 44,600 for the banking index. Now, last week, if we see which sectors and stocks were in momentum, we saw stocks from the railways, cement, auto, pharma, IT, capital goods, all displaying excellent momentum. So, barring Bank Nifty, most of the sectors saw some good action in the last week. Also, we expect the momentum in these spaces to continue in the coming week also. So, if you speak about railways, IRCON, IRFC, RVNL, a lot of these stocks, Railtel, saw some excellent moves and a fresh breakout at higher levels. Now, coming to IT stocks, we've seen fresh momentum build up in stocks such as Tech Mahindra, TCS, HCL Tech, Infosys from the large cap space, as well as Coforge, Emphasis, KPIT Tech, Birla Soft, LTTS, Tata Elxsi from the mid cap space. All these stocks have seen a big build up on the long side, and we feel in the next week also these IT names could continue moving up post some consolidation, because if the Bank Nifty has to underperform still, then to keep Nifty afloat above 19,550, it will require a massive effort from the IT stocks from here on also to support the Nifty. From the capital goods space, we saw BHEL, Siemens, L&T saw some decent long built up in the last few days, and these stocks should be on the radar. Autopack, led by Eicher Motors, Hero Moto, Tata Motors and Bajaj Auto, also witnessed some strong momentum and outperformance against the broad-based indices. And in the pharma space now, here this index is a fresh lifetime high. Good new fresh breakout was observed in Oro Pharma, Cipla and Dr. Reddy also. From the broader market, bullish setups were observed in Kolpal, Grasim, BEL, Exide, Dalmia Bharat, insurance companies such as ICICI Pru, HDFC Life, ICICI Lombard. Apart from that, Info Edge, Dixon and Apollo Hospital also saw some good build up on the long side. And here, see, all these sectors and stocks which we are discussing, not only is there data supportive, along with that, the charts on the daily, weekly and monthly time frame are also looking extremely positive. So, and I always feel that one should look at all the time frames of charts, and wherever there is outperformance visible, only those stocks should be chosen for momentum trading as well as short to medium term investment perspective. Now, coming to FII DII data in the cash segment yesterday, after 2-3 days of buying in the cash segment, we saw FIIs turning sellers once again to the tune of roughly 480 crores, while DIIs too were sellers yesterday to the tune of 565 crores. FII's long short ratio for index futures is weaker around 20-21% as they have squared off some long positions and initiated fresh short positions yesterday. On the stock futures front, however, FIIs have bought closer to the tune of 18,000 contracts, and with this, for the first time in the series, they are having net long positions in stock futures. So this also adds to the conviction that markets have become more stock specific in the last few sessions. On the options front, FIIs have sold 1,42,000 contracts of index call options, and they've also sold 70,000 contracts of index puts. So just to summarize, key support level for Nifty would be around 19,550, 19,570, while the resistance would be around 19,850, 19,900. Above 19,900, index can witness a further momentum build up to 20,050, 20,200 in the days to come. For Bank Nifty, key support would be around 43,100, 43,200, and the resistance zone would be 44,100, 44,200 initially. Only if it moves above 44,200, Bank Nifty can witness a further momentum build up to 44,700, 44,800. We still feel that the stock specific theme in the broader markets could continue while indices consolidate in a range, and all these sectors and stocks from the railways space, cement, auto, pharma, IT, capital goods could still be in good momentum in the days to come. So remain stock specific rather than concentrating too much on the index would be our view. So that's all for this week, friends. Wishing you all an excellent weekend ahead. We hope you have enjoyed listening to our podcast and are finding it useful for your trading decisions. Kindly do subscribe to the channel for such updates and interesting insights, and do share it with your friends and relatives. So until we meet again next week, happy trading, stay safe. Thank you all once again.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.